Today we are going to complete the major financial management. We have two new topics, the Chapter 7, Chapter 8. Then we continue with the exam discussion, okay? So first of all, let me introduce you. The Chapter 7 is based on the performance evaluation, behavior, and concentration management account decision making. But we're going to study about different methods, how to make a decision and the projects. So, as you remember, before we have looked at the techniques and methods like net present value, NPV, internal rate of returns, as well the payback period, right? And average rate of return. So this is, we have studied 4 kinds of methods and techniques, how to make, that will help us to make analysis and evaluation on the projects. So in this Chapter 7, we are going to continue with the decision making based on the performance evaluation of a company. Let's see. So we have some financial measures in investment centers. They are actually focused on summary profit-based measures used to evaluate the performance of profit centers and investment centers. So right now we are going to evaluate the investment centers, how they do work actually, the efficiency of performance. So we have 2 kind of methods that we can evaluate and make analysis of our investment centers. The first is called the return on investment, which is ROI. Here is, let me show you. And the second is the residual income, RI. This is the 2 types that separate and help us to make, let's say, to make analysis of our investment centers. What is the investment center? The first 4 investment centers, it's all those projects, proposals, and offers that we are running or going to apply in the companies. So we're going to measure how the investment centers are actually being performed and how much and what profit brings to the company. So the first is a return on investment. This actually technique will help us to measure the performance of investment centers. That means to measure the performance of investment or project. The formula is following. So you have to get your profit. This is if your investment over the few years, then you have to get the all profits over those years. And divide on invested capital. This is how much you did on invested cost. And multiply on 100. Then you will see the return on investment in the percentage. How much you actually return from the investment. How much profit you can get from your investment or any kind of projects. And we can use the formula at different ways. Just I want to show you that what is the profit and what is invested capital. Like invested capital, we can define from the sales revenue. This is would be under the profits. And let's say after that comes with the return on sales and multiply on invested turnover. So this is another formula so you can use to find your return on investment. But basically the first formula is the better and easy to make calculation. But this can be used as well. Return on sales and multiply on the investment turnover. You will see your return on investment. The first formula is here is that the profit which is divided on the invested capital. This is seems formula to the average return rate. You remember the previous chapter ARR, but there is you have gotten some average profit over the years and invest on the capital to see how much profit the investment the project brings every year. But here is we are looking at the overall amount of profits of the project. So the profit here is means you have to get your all profit that you get from the investment. Next, see what is actually invest capital? The asset that the investment center has able to generate the profits. What kind of assets we have? The assets like in cash terms, right? Would be the money in cash or the cash in banks or some kind of like marketable securities. All those assets can be invested in the project, right? What is the return on sales? This is the percentage of each sales dollar that remains is the profit after all expenses are covered. This is like how much we get the profit from any kind of investment, but the profit should be taken after deduction of all expenses that the project was included. So the reason means we are getting the net profit. What is investment turnover? The number of sales dollars generated by every dollar of invested capital. So the formula is telling that take your sales and divide on invested capital. Then you'll get the investment turnover, right? Like, let me show you. Like sales divide on invested capital. This you can get the investment turnover. Or return on sales. The sales divide on the profit. After deduction of expense, you will get the return on sales. The formula is already the explanations of each term explains the formula how to use it. So I had a question about return on investment. Which formula we can use? The better is you use the first formula. We have two formulas. Like first of is profit divided on invest capital multiplied on 100, or the return on sales multiplied on investment turnover. But in the second formula, there is it's a little complicated because first of all, to find your return on sales, you have to find this return on sales to use this formula that was at the next slides. And investment turnover, of course, to find your investment turnover, you have to get your sales and let me see the sales and divide on invest capital. The first formula is the simplest and show you the right answers. But as we are studying the financial management and different techniques, I have to show you all the formulas that we have to find the return on investment. So how we can actually improve our returns from investment from our project actually. First is increase your return on sales. That's how it can be done. By increasing just the selling price or the sales revenue or decreasing the expenses. That means the question is similar to how we can increase our profit in the company, right? The profit can be increased if we reduce our expenses, all expenses, or if we increase our selling price for the products, right? Or to acquire the new customers, increase the sales revenue. This is what that means. Next one, or increase the investment turnover. This can be done by increasing the sales revenue or reducing the invested capital. So if we reduce our invested capital, then of course we can save the money in the company, right? Or just increase the sales revenue. That means to increase our sales revenue, we have to let's say that all the action will be getting by the sales department and let's say the marketing department. Maybe to increase the sales revenue, we have to introduce a new product, good or services, or we can run some advertising campaign, right? So this is all would be on the marketing department. Acquire the new customers or offer some discounts. That all these actions actually will should actually increase the sales revenue. So here is I have a request to make a break for 10 minutes. If you are okay, I'm fine. So let's make a break right now. If you are all agree, because I'm not sure you are all from different cities. That for me it's difficult to identify at which time it's better to make a break. So if you are agree of you to make a break right now for 10 minutes, we can do it. Okay, thank you. So just make a break for 10 minutes. Thanks. So how we can improve the return on investment? Here is given to you two ways. The first one is increase your returns on sales by increasing the selling price on products or decreasing your expenses, or just increase your investment turnover, increasing by increasing the sales revenue, or reduce your invested capital. So that means if you reduce your invested capital, that means you won't make any investments as a project, so you do it at least so that you can save the money. But depends on the companies. Actually, depends on the company size. Companies, let's say the companies, the geographical locations, companies' strategies, that which way they will or be applied in this case. So, and this is the actions. How to improve your return on investment is they are actually considered on the short-term terms compared to different actions like we have seen before that. Because this is if we are apply those actions like increasing the selling price, it shows some results in the short terms only. But of course, it will affect our long terms, actually the performance of the company in the future, right? For example, today, that in the example I can explain like you need some money or to save money in the company, to save your assets. So, for example, based on the second like offer, which is first increase your investment turnover, you can reduce your invest capital. Like you won't invest for any kind of projects. At the short terms, you can save some money, some assets in the company, right? But this affect your company performance in the future, in the foreseeable future. So you won't get any additional profits, right? So this is what says the statement and the two kind of recommendations how to improve the return on investment. So what is the advantage of return on investment method? It's very widely used to measure the performance of divisions and managers. So because of this method, we can, if you would like to analyze or evaluate your managers or your divisions, like your department in the company, based on the investment centers. So you can use this method, return on investment. It also encourages the manager to focus on profits and the assets required to generate those profits. That, of course, if the return on investment formula shows that we have to get our profits and divide on capital invested, that we all are focusing and centralizing on the profits measures, right? But the profits is as well shows the relationship between our revenues, the costs or expenses, and as well the assets. So actually, this method we can use in a business unit with the different sizes. Like means we can use this method at the companies with a different size, at the small, medium, or huge companies. This method can be applied for different size of companies. What are the limitations of this technique? It encourages the manager to focus on short-term financial performance. You remember, as I told you, so we are actually considering and focusing on the short terms. But this is seems as one limitations of this method. As well, it encourages the manager to defer the assets replacement, which means to maintain the high divisional returns and accrue high performance. That we cannot. That means we are using here is the assets which cannot be replaced. That in that kind of projects. It discourages the manager from investing in projects which are actually acceptable from the organization point of view, but decrease the investment center's return on investment. So sometimes, actually, when we use this kind of methods, we can reject the project which can be seen as very interested and profitable for the company in foreseeable future at the long-term conditions. So because of this method, it's focus on the short terms only at the short terms project. Then it will be difficult to make evaluation on foreseeable future. On the profits for foreseeable future from any kind of project. So how we can minimize the behavioral problems of return on investment? So use the return on investment as one of series of performance measures that focus on both short-term and the long-term performance. As well, consider the alternative ways of measuring the invested capital to minimize the dysfunction decision. So we can actually use the previous techniques to evaluate our invested capital in our project that we have done in the chapter 6. And as well say that they use alternative financial measures such as residual income or economic value add. So that's why the residual income we are going to study the later slides. So right now I'm going to show you how we can make a calculation based on return on investment on the project. Let me show you this example. Here is giving you example like increase in the return on investment over the time. So we have some project where is the let's say project capital expansion investment. This is the so we are acquiring some equipment which is cost us $500,000, and useful life of this equipment is estimated over the 5 years. Salvage value at the end of useful life is 0, so we have no on any residual salvage or value or residual value. So we have some depreciation of this equipment. So based on the straight line depreciation, it will be 100,000 every year. Based on so that means we're using only one method, the depreciation, which is straight line here. And annual profit which is generated from the assets, so we are getting some profit, is equal to 150,000. So first of all, let me explain. So we have some project, let's say the investment project, that we are buying a new equipment. This is all as well seems as investment, right? So we're buying the equipment which costs $500,000. So the useful life of this equipment will be 5 years. And as well, we're going to depreciate these expenses, and depreciation charge will be 100,000 every year, right? Based on the straight line method. So you remember straight line method formula that you have to get your cost, which is 500, and divide over the useful life of equipment. So we can get that the depreciation charge will be 100,000 every year. And as well, this equipment brings us some profit, which will be equal to 150,000 at each year over the 5 years. So, and before, to make a calculation to find the return on investment from this project, how much we actually return in the percentage, how much we can return our money from the project, let me explain the first. We can make a calculation based on the two different methods. We can use the gross profit and the net profit from the project. The previous slide showed you what is the advantages of net book value or the net profit from the project. It consistency with the balance sheet that is prepared for external reporting purposes and consistent with the definition of profit. So here is in the net book value of equipment, we are going to charge our depreciation costs from the profits and show it in our tables, right? And the gross book value, what's the advantages? Depreciation is arbitrary and should not be allowed to affect the calculation. So here is we are not going to charge our depreciation costs. And as well, the depreciation for non-current assets may provide some disincentive to invest in new equipment. So we can use two methods to identify our return on investment based on the gross book value or net book value. The net book value includes the depreciation charges, okay? The gross book value, they exclude the depreciation charges. So let me show you in the example. Here is, we are going to show that what profit before depreciation, what kind of profit we receive from the equipment is 150,000 each year. Can you see that over the 5 years we received some fixed profit, right? We have some depreciation charges from this equipment. It's 100,000 every year, right? And if we are going to consider our depreciation charges, the net profit from the equipment will be 50,000 only for each year, right? This is 150 profit minus your depreciation, 100,000. Then you will get the 50,000 of net profit after depreciation. And average net book value shows you how much we have a value from the project. The first comes is 450. This is the amount, deduction 50,000 from that invested capital 500. So you'll get 450. And over the 5 years, it's been decreasing, and shows that at the end of the 6th year, we have 50,000 of the profit from the project. Based on the return on investment, which is would be based on the net book value, includes the depreciation charges. Our return on investment for the first year will be 11.1%. Can you see the formula? I can give you, as you remember, it was the previous slide that you have to get your profits and divide on the invest capital. So you will get the your return on investment in the percentage. Of course, don't forget to multiply 100. So this is, let me type for you. Here is. So you remember return on investment is equal to profit divided on invest capital and multiply 100. Okay, I think that request Mr. Rashidi, he didn't mute his microphone. Let me mute it. Okay, I think I have done it already. So I hope you can hear me well. So I think I already muted all of you. So, and how we have got the return on investment for the first year is the 11.1%. This is from, if we follow our formula, the profit which we have 50,000, we have to deduct to our invest capital. Is where it comes. Let me show you just again. Okay, 50,000 divided on 450, which is the average net book value from the project, and multiply on the 100%, you will get the 11.1% of return on investment. That means we received 11% of profit from the invested capital. So this is for the first year. Have you seen in the chat board that what I'm typing for you? For the how we got the 14.3%. This is the same we do. 50,000 of profit divide on your average net book value, which is in the second year is 315. Multiply on the 100%, you will get the 14.3% of returns on investment, of returns of capital from the investment. Okay, this is, and we do over the 5 years, the same formula we use. How did they find the average net book value? This is how much we have invested. Remember, we have invested 500 and minus 50,000 that we receive the profit, then you will get 450 already the average net book value for the first year, like this. For the second year, it's already you have to get your average net book value from at the end of the first year, 450, and the minus your 50,000 of profits, you will get the 315. Oh, sorry, you have to minus the 100 already because for this 2 years, you will get the. And here is actually already giving you explanation. Let me show you that I missed it. The average net book value is the average of begin and ending balancing for the year in the net book value. So in the year 1, its example is following. So we are taking the average net book value 500. At the beginning year, that means we invest 500,000, right? Plus 400 is already with the charges of depreciation and divide on 2. So you will get your 450 of average net book value for the first year. For the second year, you do the same things. That means you have to get the 400 and plus 300 and divide on 2, right? So that that you will get. This is another way how you can make calculation to find your average net book value. Let me show you one more again. Just a moment. So here is, this is for this year 2. Here is. This is first we have to find the average net book value, then we can find return on investment based on the net book value. If we are not, for example, in this case, if we are not going to consider our depreciation charges, then we can get just the gross book value, which is every year will be 500, right? 500 is that invest capital. Okay, I have a question that asks me how we get the 400. The explanation is here is, the average net book value is the average of the beginning and ending balance for the year. So beginning, how much we invest, 500, and the ending minus depreciation charges is already 500, right? Let me show you. 500 minus your 100 depreciation charges, you will get 400, which will be net book value at the end of the year. So, and you do all the same calculation for over the 5 years. If we are not considering our depreciation charge in the project, I mean in the investment, then we can use the simple formula that we have used. So, how much you will get the profits every year? It's 50,000, right? Just 50,000 divide on your 500 of invest capital and multiply on 100%. You will get the 10% of return on investment, and it will be fixed for over the 5 years. Okay, I have question that asking me for the year second. You have got a different amount, is 400,000. You remember you have to get the net book value for the beginning and the ending of the year. What it was at the beginning of the year, at the beginning of the second year, is already 400. You remember, because we already was making the depreciation charges. So that means 400 plus at the end of year, how much your balance will be? 400 minus 100, which is the depreciation charges, it will be for 300, right? That's what I'm talking about. So we have to get the balance at the beginning and at the ending of the year. For each year will be a different amount if we are considering the depreciation charges, because we are charged our depreciation cost over every year over the 5 years, right? That's why it's important. Let me show you. Yeah, okay, thanks. So you got it already. You do understand how we do. So, and if we are not considered depreciation charges, then the formula will be easy. You'll get your profit after depreciation, which is the 50, and divide just on your invest capital, which is the 500, and multiply on 100. You'll get the 10% return on investment over the 5 years. That means in this formula, the returns will remain at the same percentage over the 5 years. So which is the math is most will be best for you, that the company will consider, because each of them, which is the gross or net book value of equipment, will have their own advantages. Let's move. Next, the next method how to evaluate the performance of the invest capital, we use the residual income. What is actually residual income? It's an approach to equity valuation that formally accounts for the cost of equity capital. So we are evaluating our equity, our capital, right? The equity is the same as the capital, right? Here is the residual, means that in excess of any opportunity cost measured relative to the book value of shareholders' equity. So the residual income is then the income which is generated by a company after the accounting for the true cost of capital. The residual income, that means is that the profit, that income of the company which is made from the investment project after deduction of all the costs, true costs of capital. Let's see the formula we can use in this situation. So residual income is equal to have to get your profits and deducted invested capital multiplied on the inputted interest rate. So here is, we know what is invest capital already, right? This is investment cost, how much we invest in the project, in the equipment, right? And the profit, we know already the terms of profit. The profit or revenue generated from the project, from the investment or project. What is actually input interest rate? It's actually based on the required rate of return that the firm expects of its investment, which is as well based on the organization's cost of capital. So this is same as you remember, we have done some the required rate, the rates we used in the net present value methods. This is the rate, discounted rate actually, discounted rate. And this discount rate must be equal to the company's cost of capital. That they will make calculation and can find these rates. How much actually a company costs to make any kind of, to invest for the project. And we have another terms which can be used in the input interest rate, is the weighted average cost of capital. What is actually? This is the weighted average of cost of all the funds from all sources of borrowing and the equity. So that means we have to get all the borrowing money and our equity, our capital, and deduct from all the costs that we made to generate these borrowings and equity. So, and we will get some rates in the percentage. So this is the rate can be used in the residual income. So I think I have some examples for you. Let me show you again. What is the advantage of residual income? It's more like to promote the goal congruence in compared to return on investment. Takes some accounts of organization required rate of return, as NPV, for example, or IRR. As well, it encourages the investment in projects which yield a positive residual income to the organization. So as well, this is a residual income is all focused on the company's profits. Like a return on investment. What is the disadvantage of this method? It cannot be used to assess the relative performance of business that are different sizes, unlike the return on investment. So we cannot use this method different size of companies and to make some analysis and comparison. And formula is based in favor of larger business unlike return on investment, and can encourage the short-term orientation focus like return on investment. So this is the two methods, the residual income and return on investment. They actually help us to evaluate the performance of invested capital, the investment centers. actually performance, how much profit we actually can get from the investment projects. Okay, this investment project can be different. That, for example, we can buy some equipment. This is as well investment expenditure, right? Or to expend our money to some advertising campaign. As well, this is also we can measure our profits to see that our sales revenue is being increased or decreased. So this is two methods help us to identify how we actually using our capital in the company, at which efficiently, how much efficiently, how much effectively we using our capital in the investment project. And it shows, the result, it shows the percentage of profits from the investment, from the cost that we made in the project, so in the percentage. So we can, of course, make comparison with a different project, for example, inside of our company, or between the project of different divisional or departments in the company. Or, of course, you can make some comparison with the same or similar company as you have, to make comparison and evaluation of your performance, organization's performance. So that's all for the chapter number 7, how we can evaluate the performance of invested centers. Some of you asked me to explain the slide number 10. Let me see. Let me back on slide number 10. Okay, the calculation is the same for the return on investment. So I think I have done already, and I thought you have understood. So this is like we have at the previous chapters. You remember we had different investment projects, right? Or we can call it investment expenditure project, or investment offers or proposals. This is how we expand our money, the capital money in the organization. So in this example, just show you that the company are going to buy new equipment. And this equipment actually must be depreciated, because all the assets, fixed assets, will be depreciated, right? And as well, this equipment brings some profit to the company. Like, for example, at the previous examples we have seen, like medical center going to buy a new CT scanner. Let's say this is a CT scanner in the new medical center, which cost is 500. And useful life of this CT scan would be over the 5 years. As well, will be depreciated by the straight line method. And depreciation charges will be 100,000 every year. And this equipment brings some profit. That means because of we buy some new or additional equipment which costs 500, it brings a profit in terms of, for example, we can get more patients, and the queue will be reduced in the medical center, and so on. So, and this profit, it will be equal to 150,000 every year. So I hope this part is clear, right? That's what is the acquisition cost. This is invested capital in the equipment. So, and the assignment said that we have to find the return on investment from this project, like how much profit in the percentage we can get from our investment costs. We can use two methods. We can calculate the returns based on the net book value after depreciation charges, or gross book value without the depreciation charges. here is this one what we are going. First of all, let's see the calculation of the return on investment based on the gross book value. This is simple. You remember, if you go to the previous slide, the formula of return on investment is the profit divided on invested capital and multiply on 100. And profit here is we know that we can get the profit is 50,000, right? So we do apply the 50 and divide on invest capital, which is 500 of invest capital. All is in thousands, of course. And then we have to multiply on 100, and we can get that it's equal to 10% of return on investment, ROI. This is which is the base on the gross book value of equipment. So I have typed you the calculation. So based on the formula, profit, which is 50,000, divide on 500, which is invested capital, and multiply on 100, you will get 10% of return on investment based on the gross book value. That means we can receive 10% of profit from the invested project, from our new equipment. So it is 10% for each year over the 5 years. That means we receive every year 10% of fixed profit. What about if we use the net book value to calculate our returns on investment that I have shown previously? That will be different. At each year, it shows a different amount, have you seen? And every year will be increased. So this is how we do. So I have some question from Mr. Shukur. He says when we get return on investment, then we deduct it from the depreciation. I didn't get your question, sorry, because depreciation charge will be already made. Here is, have you seen annual depreciation? And we are getting the profit, net profit after depreciation, which is the 50,000. In the both variations, in the return on investment based on the gross book value and ROI based on the net book value. The difference is about the average net book value, how we do calculation of the average net book value here is. So first method is which is show you the return on investment based on the net book value. Is based on this average net book value where we get the value of equipment at the beginning of year and at the end of year, and the average of this amount at the beginning of the year is, for example, the first year is the 500, right? Because we buy this equipment for 500. At the end of year, the value of equipment will be already 400 because already with the depreciation charges minus 100. And to get the average, we deduct for the two, and you can get that the average net book value for the first year will be 450,000. I think that I didn't show you calculation. That's why I have a lot of questions about how we can do it. But it's fine. Let me do it right now, because if you didn't get that, Okay, I just want to type for you that's how we got the average book value for the each year. Like 500 plus, sorry, the 400, the 500 is it's a book value of the equipment, the price actually, the cost of equipment at the beginning year, right? Then it comes to 400 because of why? Because we already charging the depreciation. It's a 500 minus 100. It will be 400, right? Then we have to deduct this amount to get the average net book value. You will get the 450. That's here is some scopes must be. Here is that, right? Year number 2. So what we do? We know that the book value for the beginning of the second year is 400, right? Right, 400. Already with depreciation in the first year, which was 100. And plus, at the end of the year, this depreciation, how much will be? Because of 400 minus 100, which is the 100 depreciation charge must be deducted each year, is a 300. Then we divide on 2 to get the average amount. You will get 350. This is the average net book value for the second year. And here is scopes. Just third year, the same. Third year, it was a 300, right? The value at the beginning year of the equipment is a 300. Because of this amount, let me show you. This is 300. If it's end of the second year, it means it's the beginning of the third year, right? So then we have, oh, sorry. If we summarize it, we have to plus it with the book value at the end of the year, with 300 minus 100 depreciation, our depreciation, and all must be divided on 2. You'll get your 250. Can you get it? Can you see the calculations? So here is very important. The book value at the end of the first year, which is the 400, comes at the second year, which will be the beginning value. You see, this is the two same amount. Then next one as well, the book value at the end of the second year is the same as at the beginning of the third year. It's a 300. If you do continue your calculation, you can find that for the year 4th and the year 5th accordingly. So can you do it your own so you can make... So I have questions that why we actually accumulate all this cost of equipment at the beginning and the end of year with the depreciation. Because we must get our average net book value of equipment. Let me show you this. Here is average net book value. So we can find our return on investment based on the gross book value or net book value. What is the net book value? Is the average net book value as we here is comes. Two methods. Here is giving you two calculations. So this is return based on gross book value or return on net book value. So, and the companies can select or choose the one of the method to make calculation based on gross book value or net book value. And the advantages and disadvantages is given to you at the previous slides. Here is advantages. What is the advantage of net book value? It will be consistently with the balance sheet, you see. And will be more consistent with the definition of the profit itself. But what about the gross book value? Here is advantage of gross book value. It says that depreciation actually should not be allowed to affect the calculations, and depreciation also of assets may provide some kind of a new investment in another new equipment. So the companies use one of those methods, which can be considered on the gross book value or net book value. That's all for our residual income and return on investment, two methods which help us to make evaluation of performance of the investment center's performance, right? Okay, the next chapters we must finish today. Here's chapter number 8. It's on the decision making and the condition of risk and uncertainty. So we're going to study about two kinds of models. There's the Minimax and Maximin criteria and capital asset pricing model. What is the Minimax and Maximin criteria? This is actually how we are going. This is all about evaluation analysis of projects, of the decision making. And this conservative approach is saying that the least worst possible outcome that could possibly occur is selected. Like, for example, we have some project, and we have to choose one project from a few different ones. How we can do it? Just in simple way, like using the Minimax criteria, which applies to the cost, like how much we invest in the project. Let me show you. So we have three projects: project A, project B, and C. We have some cost from the project X, and Z. Sorry, here is the names of project this one. And we have some possible costs of outcome. That's possible cost of those projects. As well as there will be a different one. How much we can cost at each project. At the first project X, at the variation A, we can cost 80 or 70 or 95. And Minimax, what that means? You have to get the minimum cost from project X, the variation of minimum cost. It's at 95, right? Minimum cost. The cost is that the money, the cash outflows, right? What is the minimum, the least worst cost will be in the project X? Is it 95, right? So all the figure is negative because the possible outcome is all our cost. From the project Y, we have the three variations: 90, 75, and 80, which is the biggest cost from those variations is 90, right? And project Z is 100, 87, and 78. The variation, of course, with the biggest cost from the project Z is 100. And from this of all of biggest cost from the projects, we must find the minimum cost, cost from the biggest one over the three projects. Is it 90, right? Like first, we identify the maximum cost over the projects, the possible cost over the project. Then from those results, we have to identify the smallest cost from the projects. And here it seems that the project Y is the best project over the three variations. Here is, oh my gosh. Here is, because it has the lowest cost between the project. That's why it's called the Minimax. So we have to choose minimum cost from maximum variations. Minimum from maximum. That's Minimax. Next one, we have Maximin criteria. How we can choose the best project. It applies to profit actually. As well, we have a three project X, Y, and Z. Have you seen? And three different possible profit that project can bring to the company. Like, let's see the project X. It has a profits, the variation of profits 80, 70, and 95. So from these profits, we have to find the smallest profit. Which is the smallest profit? Is 70, right? And we do accordingly for the project Y and Z. First, we have to find the smallest profit from the possible outcomes. In the project Y is a 75, sorry, and the project Z is a 78. Now, as we have identified the smallest profit from the project, we have to find the biggest profit over the three projects. Is it 78? Is the project Z, right? This one, project Z. Which means the best possible outcome can be done by the project Z. So, and Maximin criteria applies to the profit. To the project where we can make evaluation analysis based on the profits. The Minimax is the analysis based on the cost, but Maximin analysis based on the profit. So you can, as well, you can use these two kind of criteria to choose the best outcomes from the projects. So, are you clear with this criteria, Maximin? So first we have to identify the smallest one, the smallest possible profit. Then from the project we have to find the biggest, the highest, let's say the highest profit from the project. Next one is the regret table. Regret table as well we can use in the project based on the profits, where we would like to maximize the minimum regret, to maximize our minimum profits. Here is, first of all, we have to first to select from the project which is the highest possible profits. From the project X is a 20, right? From the project Y is 15, and from the project Z is 17. After that, we have to find the minimum profit from these three projects. It's how much is 15 under the project Y. So, because of this regret table, we do identify the worst possible profit from the project. That means we can maximize our minimum regret, which means we can maximize our minimum profits from the project. That's all about the Maximin. What is the limitation of these two criteria, Minimax and Maximin, where we can do just a simple selection of best possible outcomes and worst possible outcomes. They are actually too conservative, as you can see. Just we are selecting the figures only. As a project which is slightly risky, yet reasonably profitable, may be rejected out of hand. That means sometimes we think that the project is risky, like can be the can like get the highest outcome, highest expenses. Like for example, the project needs more investment than the rest of. But the highest risk, that means it might be that the project brings the highest profits, right? As well, these criteria, they are actually ignored the use of probabilities, that we cannot make a probabilities among of these two criteria. And as well, they ignore the alternative of not selecting any kind of project. This is actually, you cannot use the Minimax and Maximin criteria in your company only to be focused on these two criteria to choose the best project. It's like if you want to screen between your project which brings the maximum profits or gets the minimum cost, then you can use these criteria just to see how much the project they cost, which project costs more than the rest of, or which project brings more profit, the highest profit than the rest of them. So this is that for screen only. I won't recommend you to use these criteria based on your investment projects. The best is net present value and internal rate of returns. This is, I think, in my opinion, is the best methods to choose the project and make a decision. Because they consider time value, they consider the profits, they consider the cost, as well they consider all the discounted rates, right? So this is why I will recommend you to use the net present value and IRR methods. Let's see, what is the risk aversion? Actually, as we have explained previously, that sometimes we can reject the project with which is very highly risky and needs more investment, because that kind of project can bring more, let's say, the highest profits. Like for example, the more you invest, then you are expecting to receive the highest profits, right? What is the risk aversion? It's defined as a degree to which investors are willing to commit the funds to investment. So it depends on you. We have actually three types of investors. Maybe you can find yourself from these types. Like we have some categories. Like first is the risk-seeking investor. This is investors who like to accept risk. They like to accept the highest risk, which needs a very huge investment. And they like to purchase investment of high risk for relatively small increased returns. They are said to be aggressive type. Like even the project brings very small returns, small profit, they are actually accept those projects. with the highest cost. This is aggressive type of risk investors. The next one is the risk indifferent investors. These investors that would be satisfied with if they will get their capital back from the investment. At least they will need to get their capital back, and they will be already satisfied. Not that beyond of that they will get some profit. And this kind of investor, they say to be of moderate type. Like, for example, I have some project. I'll invest 100,000, and if at least I can get back my money, my investment, then it's already okay. I can accept this project. And this is moderate types of investors. Next one is the risk-averse investors. The investors that require an additional return for an additional increased risk. And they are said to be of conservative type. That means, okay, if I do can invest some additional 50% of my capital, then I have to get the same profits from that investment. So they are actually expecting to get some additional profits from the additional risk. Like more risk, more profits. That means that this is a conservative type. If you are some of you are investors, are going to be investor or already made some investment, you can find your type. Are you aggressive type? Never mind how much returns you'll get, you can accept the project. Or your moderate type, you need at least to get your investment money back. Or you are a conservative type, like for additional risk you must to get additional profit. So for additional risk, this is, I think, the conservative type is the most, let's say, I can't say that the best type, like most logical and mind type, right? The conservative type. So if you can find yourself among these types, or identify yourself, or sometimes we can be different types of investors at the different projects, right? It depends on the project itself. So we have some another kind of method is called the capital asset pricing model. This is actually this capital asset pricing model, or CAPM, that shows the pricing model, the price of the company, actually, the price of how much actually the company value on the market. The use of capital asset pricing model include the establishment of what the current equilibrium market value of the company shares. That means we're going to identify the value of company shares in the markets. It establishes the cost of company's equity, taking into account the risk characteristic of company investment, both business and financial risk. And as well, we can identify the company's costs based on the equipment that we have done as well in the previous methods. Here is, let's see what types of risk we have. Because all we're talking, the projects is all will be equal to risk, yeah, right? How much the risk takes in the project and the project. We have a systematic risk, or we call it market risk. It cannot be diversified and must be accepted by shareholders. Sometimes we have some market risk, and it not depends. It not depends on the company. Like market risk, let's say like some the fluctuations of the currency in the country, or let's say about the competitors, that we have some monopolies in the markets, or let's say some financial crisis. All these market risks And this kind of risk the shareholders must accept because they cannot impact on those risks. And we have some unsystematic business risks, can be then diversified. This is the business risks that we actually can manage those risks in our company. For example, based on the project, to choose the project with the lowest risk and the highest profit, let's say. And the capital pricing model, which is actually evaluating the company shares, is measured to identify the risk of the company. And let's see how the market risk can affect the required rate and the share prices. Here is the formula comes next. This is like, right now we are going to identify the value of shares, of the company shares in the market, and how the market risk, that all the external risk can affect our shares price, the price of the shares. Okay, let's see. The formula here is RS, which is expected return from the individual securities, like returns from the investment, equal to RF is the risk-free rate of return, and B is the beta of individual security, and the RM is the return from market as a whole. I have some examples based on these calculations. Let me explain you first, because that would be difficult, complicated for you. For example, the company X and the company Y both pay an annual cash return to the shareholders of 34.4 around 34 pence per share, and this is expected to continue in perpetuity. That means two companies, we have a company X and company Y, they pay some annual cash return. That means this is the shareholders' price, 34, let's say US dollars. And the risk, which is the free rate of returns, is 8%. And the current average market rate is 12%. The company X beta coefficient is 1.8 in the company X and the 0.8 in the company's Y. So what is actually expected return from companies Y and X? Y and X respectively. That means we have to find how much the two kind of companies receive the returns from their investment capital. Because in this formula we are considering all the risks that can affect the investment projects, like a market risk. Here is 12%, or another free risk that is 8%, which identified by the company, and some coefficient which is better. It's each company identified by themselves how much coefficient of the assets will be. Let's see their calculations. So we use the formula to make calculation to find the expected returns from each company. As here is after calculation, you have results that the expected returns from the company X is equal to 15.2%. That means the company X expecting to return the money back from investment in the 15.2% of profits. Okay? And let's see the calculation of next. The company Y is expecting to get its money back in the profits of percentage 11.2%. If we do compare two companies Y and X, which company you think is can get back the highest returns? Of course, it's the company X, right? Because its expected returns is higher than the company's Y, is 15.2. Here is another example for you, the question number 2. That said the risk-free rate of return is a 7% identified by the company. And the average market return is 11. So we identified in the market the average returns would be 11%. And what is the expected returns from the shares whose B factor is 0.9? So we have identified the coefficient of our returns on assets is 0.9. After calculation, we have results that the company in this situation is expecting the returns of profits in the percentage of 10.6%. It's around 11% of returns from the investment capital. So that's all for the chapter number 8. It was very short. We have seen. So let me conclude you the chapter number 8. We have taught two kinds of criteria, right? The Maximin and Minimax, where we select the least worst possible outcomes from the project, right? And we have seen the pricing model of shares, how we can evaluate the company's shares on the market. So right now we're going to move on the exam instruction. So right now we're going to discuss about the exam. Are you okay with that? Any questions so far based on the 2 chapters that we have done already? The chapter 7 explains you how to make evaluations based on the performance of the investment capital. How we use the efficiency, actually the efficiency of using our capital. That's in the simple words. And chapter 8, it just shows you that the first how we can select the best worst possible outcomes from the project based on the profits, of course, and how we can evaluate the company shares in the market that's given to you formula, and how actually the market risk can affect your price. Of course, you have to consider that the whole market changes, and the risk, the external risk will affect the company's prices, right? The company's value, actually, the company value. Okay, let me explain the finance exam. So, the finance exam, the hand-on date, will be on the 25th of May at 12 afternoon by Kabul time. That means 25th of May it's a Saturday. At Saturday, I will be sending you on your emails the exam questions. So we won't have any session because I already will be prepared you the exam questions, which will be sent you directly in your email boxes. Then submission date, you have to submit your the exam papers, which means your answers to questions, on 26th of May till 12 p.m. So you'll be given 24 hours to complete the questions. And, okay, let me see first. You have some questions. No, the date won't be changed. Some of you are not agreed, but this is the exam. This is how we do actually. And I have to say that we cannot change. Of course, based on the previous year request, I remember that the most students asked me to send you the exam questions on weekends, that you would have enough time to complete your answers. That's why I have chosen the 25th of May, that I am already giving you 2 weeks to be prepared on the exam, and sending you the Saturday, at the Saturday day. Then you have a whole day to complete all the answer till the next day by 12 p.m. That's it. That will begin for weekends, that you won't be worried, that I hope so you will be free so you can complete your works. And the students, you'll be given 4 questions on financial management manager. Very important things. You have to be considered and review the chapters on the financial management from 5 to 8. The last chapter we have taught. And each correct answer for the question will contain the 1 grade point. Let me explain you the example of questions. For example, you have some question number 1. You will have 4 questions, okay? Question number 1, 2, 3, and 4. 4 questions. And 1 question might or can contain a few assignments, like A, B, C, D. As 1 question contains 1 grade point, each assignment in the question will contain some certainty of total. Like if you have 4 assignments in the 1 question, then each assignment will contain 0.25 grade points, and totaling is 1 grade point. The question, for example, another question number 2. This is just example only. Like question number 2 might contain 2 assignments, and each assignment will contain 0.5 grade points, and in total will be 1 grade point. But you will have 4 questions, and each question might contain from 1 to a few of assignments. And next one is important. You have to give me a correct answer for at least 2 exam questions. Because of why? Because as we have an evaluation system it's based on the grade points from 0 to 4, like a 0 to 2, 1.99 grade points. It will be evaluated as a fail on exam or on the financial measure at overall. If you will get the grade points from 0 to 4, you will pass your exam. That means you will pass the financial management module. If the students didn't submit the exam answers at the required submission date, they will be assessed as a fail on exam. So that means very important, the submission date and time, which is 26th of May till 12 p.m. So, of course, I know we have some different time. I will be concerned about this, but try to send me your papers as soon as possible as you can complete. Okay? Let me see your questions, because there is a lot of questions. Some of you are not agree with the date, but date is already fixed. I'm sorry that I don't know at which date you have your another assignments or submissions, but this is for the finance. We have been already fixed the dates of the exam, the submission date. So, and very important, all the 4 questions based on the exam will be based on the financial management part from the chapters 5 to 8. You remember we have taught some accounting skills, but this is accounting skills was taught you to be to enter to make your to give you some skills on accounting and to enter you for fundamental knowledge of accounting. But as we have a financial management major, and all questions will be based on the financial management chapters or topics that you must be considered on the topics from 5 to 8. That is 4 main chapters that you must be considered. But that not means that you shouldn't review the accounting skills, because those chapters include some accounting skills questions, right? Sometimes, for example, the question would be based on income statement or balance sheet. You must be go back to account skills to review again, to remind how we've been prepared the income statement and the balance sheet and so on. So let me, I haven't sent you the exam instruction on your paper, in your mailboxes, that I'm going to make it after the class. And let me show you which topics you must be considered, okay? I have some financial structure that we have done, you remember? We have done some accounting skills, the topics on the accounting skills, and some financial financial management. We have done a lot of some theories and topics. So let me show you. So you have to be considered about the chapters number 5, which is based on ratio and interpretation of accounts. Horizontal analysis, trend analysis, vertical and ratio analysis. All about this review. Please review the presentations on topics and as well the practical exercise. Sorry. And the next one, chapter 6, which is based on the topic capital expenditure decisions. All about the methods we can use to make a decision on the projects, like payback method, ARR, or NPV in IRR. This all must be reviewed by you. Next on chapter 7. Chapter 7, which is based on the performance evaluation, return on investment, and RI, residual income. And chapter 8 is based on the decision making under condition of risk and uncertainty, based on Minimax Maximin criteria and capital asset pricing model. So I give you the practical assignments, which means exercise, that similar we have done on the homework assignment. So you don't worry, nothing new I will give you. That all will be based on the topics, and all the information that you need you can get from your topics, and to see the similar exercise on the homework assignments. And as well might be include some theory questions, like I want to get like a little essay or conclusion based on some performance metrics. As you remember, when we have taught like ratio analysis, let me show you. Ratio, let me show you that ratio analysis. You remember the ratios was different, and we assumed and made analysis and forecasting what kind of metrics or like say the actions would affect our performance, the company's performance. This is, you have to make some conclusion why the figures or the results would change, or was changed already, or what kind of factors would affect these changes. This like, but don't worry, that will be explained you more clearly in the papers. The most important is the practical exercise, and most important that you show me the way of your calculations. Each way of your calculation, each step of your calculations, which formula you use in the assignments. Because if you give me just answer, and let's say if it would be wrong, then it will be difficult for me to evaluate you. I just your answer can be failed. But if you like show me your way of calculation, the formula that you used, and then you show me the results would be wrong. Maybe some, some figures you will be simple calculation was wrong. That gives me another of results of your understanding of financial management. Sorry. And of course, all your marks, your correct answers from the homework assignments will be considered in the exam papers. But if, for example, if you give me if your answer was, for example, if your answers was wrong for all of questions on the exam, then would be difficult to evaluate you based on the homework assignments only, because the people who done the homework assignments, who done actually exam, that means they done some homework assignments that have a links, that must be had some links. That's what I'm talking about. Okay, I'm going to send you the exam instruction on your emails. After the class would finish, we're going to send you. I can do it right now because actually I was planning to do it before the class, and the idea is gone. And you will be given 24 hours to complete your answers. That is enough, as for example, in the university when you study offline, the exam is held on for 2 hours only. So you have to complete like same questions in 2 hours. But you have advantages. First of all, you'll be given 24 hours. Of course, this is including the night time that's sleeping. But all the students, when we do some exams or we won't sleep, or that's not like being considered. And second, you'll have access to my presentation, to all the topics we have done, and the practical exercises as well, right? And as well, you'll be given the financial calculators, or just a calculator. You can use all this stuff at your home and make the calculations. So that's why I'm giving 24 hours. I won't give you more than it, because there won't be reason for exam. So let me see your questions. And we will have another additional class. Do you remember, as I told you, that we will have a class based on the homework assignment that we didn't complete yet, right? So let's do it on the next Tuesday. And the next Tuesday we can complete the homework assignments, all the homework assignment that is left. And then as well, you can ask me the questions on the topics which you didn't understand or you need some consideration. Okay, that's what we do. On the next Tuesday, on the Thursday, on the next Thursday, it will be 16th of May. We will have a session based on practical exercises. That is not compulsory, but of course it's better if all of you come on the class, then we can solve together all the questions, all the assignments that help you on your exams. And as well, you can ask me some questions which is not clear for you. And if you have some questions or you didn't understand some topics, you're concerned about them, you mail me, or just let's take like if we need concise for one kind of which is the most important or the difficult for you, then we can do it on the next session as well. I already have sent you email. Please check your mailboxes. There is exam instruction on the financial management. There is that file that I have shown you in the WebEx program. So I just sent right now the exam instruction. Just please wait 1-2 minutes because that's maybe needs time. I think all of you must be good. That's okay. I think I did already send to all the students that I have in my mail list. So, any questions so far based on exam or based on the previous chapters, the last chapters we have done? Okay, the important thing is that you shouldn't attend the exam because the exam questions will be sent you to your mailboxes. So it's not necessary to be on the session. It won't be any session actually. You have to just to check out your mailboxes at that date, at the 25th of May at 12 p.m. You need just check your mailboxes and to download the exam questions, and then just do your jobs that when you have a free time. I mean, at, between the 24 hours. Okay, some of you say that the time of exam should be changed, but I cannot change the, the time and the exam date for request of one student only. Who actually have the access on that day, just email me and tell me when you will have access, before that or after that. But you have to find the access to the internet. I mean, this is shouldn't be some problem. I think so. I'm not sure how it's going on in Afghanistan, but at least go to internet cafe or some way to just download the exam questions only, or to ask your friends like to send the exam questions to your mailboxes. That's all. So please try to find internet access on that day, on 25th of May. You need just check your boxes, email boxes, and download the questions. That's all. No need to sit on the internet or be on the session. Just to download the questions, make your jobs, make your answers, then send to me on required date. That's all. Okay, good luck for you and goodbye. So if any questions so far, just email me. That would be the best one. So goodbye. Hope you can all pass the exam, because actually in my let's say, in my purpose is the best way if you pass the exam. This shows your the knowledges in financial management. But what we have taught actually over those three months is how much we have started in February. It's almost for 3-4 months. That should give us some results, right? So goodbye, have a nice day. See you next Thursday. We will have a practical session based on the homework assignments.